Hello everyone. TFSA or tax-free savings account is one of the great tools we have to enhance our savings. Who doesn't want to increase their savings, right? So TFSA, we can have option to either do it on US fund in US stock or US stock markets, and through Canadian investment in Canadian stocks and some other ways. Today I'm going to compare a tax-free savings account on dividend portion, where I will overlook the dividend earnings in US and comparing with dividend earnings in Canadian market or Canadian funds, and see which one actually is beneficial to us to earn more as tax-free income. An Excel file, and that's going to show there how comparing side by side an US company and a Canadian company. So okay, this is the Excel, and say for example we put US company name, it's US, the company name is company A. Okay, zoom a bit on it so that it's easy for the eyes. Okay, US company, and this is Canadian currency. A little bit space. Canadian company C. All right. Okay. Now, so for easiest, give an example, I'm just gonna go say we have invested like $1,000 for US at company A, and at the same time we have invested 1,000 Canadian on the company C. Now yearly dividend is, say for company A we're receiving $100, and for this company C is the same amount, is $100. So far so good, right? This is all. Now if it's on a TFSA, remember this is all from our TFSA account, right? So okay. Investment comparison, to give a title of it so it makes it easier to follow, right? So $100. Now because of the, now go to the tax portion, right? So tax for the general tax for both of them is 0 and 0. Now it's withhold tax. Withhold tax is a US tax, which I will show you and talk more about it, right? So withhold tax is like for a treaty between Canadian and the US is 15%. So for the US they will deduct 15% of my earnings on dividends. So it's 15%. Oops. Now on this one, there's no withhold. In Canada, there's no withhold tax or anything because it's a TFSA, and TFSA is recognized by the Canadian government. 0%, right? So how much, if I do a total, how much it will be? So we are making, so our 1,000 is our initial. So say make it simple. So out of $100, we pay $15. So $100 minus 15 gives us to $85, right? Over here we have $100 minus 0, which is 0, right? It's $100 bucks. So this is a very good example of where we have invested the same company, invested in the same amount, we have received the same amount of dividend, but since it's in US company and US fund, there's a 15% tax on our dividend. Where in Canada it's not, it's a 0%. So over here, if I'm thinking of investing in dividends, in terms of earnings on my investment, then the wise decision will be, yes, you guessed it right, it will be Canadian, to invest in Canadian companies or Canadian investment varieties of investments. So let's go and talk about a little bit of the tax. So here is a tax implication of investing in the United States. So this is a white page from the RBC Wealth Management. If you go and over there, and you will see, so here you go, you see it's on page 3 of the white page. There is a 15% withholding tax on the dividends we receive from the US. I'll link all my references on the video description, so that you can go and study about it, and yeah, know a little bit more about it. So this is from RBC, and there is another one from, if I go here, this is from PwC, Pricewaterhouse Corporation, which is one of the top accounting firm. And if you see over there, there's a treaty. Usually it says there's a subject to 30% US taxes on it for any gross amount of business and others. And it listed the countries that has treaty and what type of percentage will receive. And if you scroll down a little bit below, then we see that in Canada there is 15%, right? There's 15% for dividend paid, and so by the US corporations, and there is some others, right? So in general it's 15%, right? And there is another source we can go, that's the main source for the from the IRS, Internal Revenue Service, which is same as Canadian Revenue Agency for the Canada. And over there is here, see, is Canada tax, and a PDF file will open, and I have to open the PDF file over here. And this is a United States Canada Income Tax Convention. And if I go a little bit down again on page 3, we will see that portfolio dividends remain subject to maximum 50% tax rate of tax at source, right? So this is how it is. So again, if I go back to the example, so even say this is withheld tax, it could be any amount, even if it's $1, then we're losing $1. So I hope that video really helped to understand why it is a wise decision to choose to invest in Canadian fund or stock just for the solo purpose of earning dividends. The major point over here is, you got it right, the tax, the withhold tax. In TFSA is recognized in Canada, so any earnings we're doing is tax free, but it's not recognized in the US. The American investor, they have called 1031 exchange, which is an investment same as a TFSA account for investment purpose. This is Maruf here from New Me Financials. I hope you loved it. If you liked it, like the video, share it, subscribe, and I'll see you later on with more videos to simplify the stocks, investment, and financials for all of us. Till then, take care, stay safe, stay home, and protect it, and wash your hands all the time. Take care.